All right, here we are. Here we are once again, taking a look at this crazy market. What do you guys think out there? It's nice to see some of you guys in here first thing. We got John out there, very first thing, Randy, and we got Albert all sitting out there. We got a bunch more people watching. If you guys want to put up your, oh, there's Jay just popped in. It's nice to see you guys. If you want to put up your little marquee, I'll make you famous. All right, guys, here we are. Looking at the S&P, actually, this is the NASDAQ 100. And this is one we generally like to day trade, but I want to show you, we're going to kind of mix things up a little bit. We've done this before, but I thought today for our day trading strategy, I had a couple of questions from some people online and also in the forum, talked to some individuals, some of my students, and they brought up a couple of things, and I thought it would be fun to go in and play with them. And that's day trading with options. It's like, why don't you day trade with options, Lamb? We used to do a lot of that, but we kind of, we shift from one strategy to the other, to another, to another. We kind of learn here. This is a learning environment. This is not, just in here to show off. This is to come in and to try and learn lots of different things that you can try and lots of different strategies. What works for one guy doesn't work for another. And we've been kind of focused lately on this scalp and trail strategy. But today I thought we'd come in and we'd do a little day trading in the markets using some options. Doesn't mean we can't do some scalp and trail. We can play with some of that too. We've got an hour here on the last hour of Power Hour. But I wanted to show you a couple of fun little ways of day trading in the stock market. Actually, this is the futures market, but in the stock indexes in the futures market. And to do that, we have to come into the S&P 500. We generally like to come in here and we like to day trade down here on the range bar chart on the NASDAQ, right? This is kind of my favorite chart. This is one I like to trade in. But to do this, I want to do options, and we'll come back over to this chart later. But right now, I want to show you in the futures market on the NASDAQ, the options chains are really thin. See, nobody trades them. 0 days till expiration. 0 days till expiration. Nobody trades. Nobody trades. All right. So the volume and the open interest are zeros. Nobody's here. Nobody's doing it. Nobody's playing it. So you can't come and play this. So you're like, but Lan, I want to trade options. I want to day trade those 0 DTE options on the futures market. I want to day trade with them. Okay, well, let's go over and do that in the S&P 500, because the S&P 500, that's where everybody day trades these things. All right, so we're going to come in here and delete our drawing tools. Well, the market's breaking up into that higher range right there. We talked about that the other day, so I'm not going to go into it in too great a detail, but there goes our, it's on the S&P 500, it's 4 drives. Drive 1, drive 2, drive 3, and we're going into the 4th drive. That's crazy, man, just crazy. We don't usually go above 3. Now you could look at this one and say, well, you only really had this one little thing and it was kind of sideways. You could almost count this as drive 1, drive 2, and drive 3. And hindsight will tell us. But right now, it broke the mathematics. I mean, you can't, it did what it did. It broke the mathematics. It broke both the, well, let's change the ATR to a 1-to-1 and see. 1-to-1. Did it break that one? It didn't break this one. It broke this one. It didn't break that one there either. But that one's not the one that we count on. It's the blue lights is the one that's tuned into to Aladdin. All right. So that's the blue lights are the ones that's tuned into Aladdin, and it broke. It broke right there. So it is what it is. It can't make it not be what it isn't what it is. It broke. So it's a drive. All right, but we take that into consideration nonetheless. All right, so we're here in the S&P 500. It's a little cleaner over in the Qs, right? So if we come back over here to the Qs, we go to the daily chart. You can see it's a little cleaner here. So in here we do have just one big long massive drive, and then we have our counter trend, and then we have one more big drive, and then we're in our counter trend. So it's a little cleaner over here in the NASDAQ. So you can see we are in the 3rd drive pattern. Drive 1, drive 2, drive 3, and we're into the drive 3. So this is C1 right up in here. This is B1 and this is A1. So that's your A drive, your B drive, and your C drive. And it's just a probability statement, right? As we go through these patterns, these recurring price patterns, we talk about Elliott wave, Fibonacci, and reaccumulation, distribution, and then Darvas boxes. And we talk about those as one setup for our overall technical long-term trends. So let's see. Randy's got pumping gas. I always Randy says he can't always make it, but he has to go pump gas once in a while, and that's okay. That's why we have it recorded. And as I've said before, we used to try and do these labs down in St. George where the university is. And we just had a hard time, putting them in places. And then, of course, people miss them because they can't make them, right? So I decided we'll just do them out on YouTube. Why not? We'll just do our university labs out on YouTube. And I don't go advertise this. I don't go try and get the whole world to come and join us. This is really for, whoever wants to come and join us can come and join us. But I really do this for our university classes. But you guys who have come and decided to be a part of it, welcome. Everybody's welcome because it is on YouTube, and I'm not against anybody coming and joining us, but realize it is a university lab, and everybody's welcome, and we're not holding anybody out. But I don't go advertise it and say, "Oh, come and watch our YouTube channel," because this is really a lab for my university classes. And it keeps the group small. I'm not here to be a famous YouTuber, so I don't really care about that. But I do like to hear from you guys, and I like you to hit the little thumbs up and let me know I'm doing good and doing well and doing the things you want me to do. Do all the YouTube things, but it's not to try and go out and pay money to get people to come and watch me. I'm not really into that. So mostly we're just here as our small little group to kind of learn together. All right, and I hope that's okay with you guys. All right, so here we come. This is the NASDAQ, and we're in the 3 drive pattern, but we can't trade options on NASDAQ. We can't do the 0 days till expiration day trading of options on NASDAQ. So we're going to come back over to the S&P 500. Now, this is the S&P, and this is the range bar 25, and this is market's been moving pretty good. So, well, wow, look at that. What's it doing right now? How comes it's so slow right now? Range 25. I want to go a little faster. The problem is when you do this, it's not exciting. I mean, we would put our order on and then we'd just sit here for an hour and we wouldn't do anything. Just watch our order. All right, we might adjust it a little bit once in a while. Well, it looks like to me the market's going to try and break a little bit higher going into the close. I don't know. I mean, we got a nice rally here, a little counter trend, another rally. This is an ABC pattern. It might just be a little pullback like this. All right, so we might get a little ABC and then the pullback back down. That's what a Fibonacci ruler would tell us, right? That we're bouncing off this 38.2, but oftentimes the market will go up, come back to 38.2, and then that's a catalyst to take it higher. So you don't know, so you just have to pick a direction. Nobody ever knows where the market's going to go. So you got a bullish side to this, and you got a bearish side to this. If we were going to play the bearish side, we'd wait for the first red candle to make a low, right? We'd wait for the first red candle. But the problem with this is the S&P 500 on a range 25. So we're going to come in here, and if we take our time calculator, where'd it go? There it is. If we go from here to here, just from that red trend, see, that was 4 hours. And for me to do this, it's going to bore the heck out of you. But I'm going to show you anyway, because it's actually a good way to trade, and you guys can do it when, we're not here with only, 45 minutes till the bell closes. But it looks like the market's rising. So we could come in here. What we could do is we'll come into the options. And if you come into the options chain, we go to the 0 days till expiration. You'll notice that there's actually, oh my goodness, S&P doesn't have any on it action going on it either. Why not? It's the August contract. Why in the heck do we not have any? There are no 0 DT. There's no. Wow. How come there's no activity on this contract? Well, there's something not right. We're not getting our volume in here. Because that's not right. That's 16 now. August, maybe we need, okay, hold on. We probably need to skip the August contract altogether. Let's go to S&P 500, S&P mini. Oh, yeah, let's go out to the September. I think the August is a dead contract. Well, no, that's the one we're on. We're on the September. Let's go to December. Has everybody gone to the December contract? Why are we not getting any volume? Look, there's no volume on here either. I think there's something broken. That does not seem right at all to me. And we're not getting any volume open interest on this thing. I don't think it's reporting properly. Because we're in the S&P 500 on the December 25 contract. Even September should have a ton of volume. Many. I'm going to have to show this to the programmers and see what they're saying. Open symbol. That should be loaded with the 0 DTE in particular should be loaded up for bear. Let's go to 1 day. See, it's all reporting zeros. There is something wrong. Something is not right. So let's just pretend like we got this is a demo account. We could probably pull up the real money account and go see if there's a difference. But right now the demo's not showing any volume. That's not good. We want volume, which is why we're not doing it over on the NASDAQ. Okay, so let's just go back to the S&P. We're running in a little bit of trouble here. Go to the S&P 25, and we're going to come down, and we're just going to place a call option. And actually, I'm not going to buy a call option. And that's the point I wanted to show you. If you think the market's going to go up, generally, you buy a call option, right? If you think the market's going to go down, you would buy a put option, right? The problem is that when we're only an hour to the end of the day, right, 0 days till expiration, you only have an hour for that market to outperform a $210 premium, and that's probably not going to happen. So what I like to do is come in here and sell a put right at the money, collect the money of $142. If the market continues to rise, I will make a profit as the time decays and takes away as time decays. It doesn't even have to rise hardly at all. It just has to, time has to just decay. I want it to rise. So we're going to go ahead and place order in here. Let's mark it into it. And so we got our put order. So we sold that and we're collected $142. So we got $142, but of course we also owe $142. So the thing that is for us is this number right here, profit and loss. We're down right now 750 because that was the spread. But now I want you to think about this for a second with me. The reason I sold a put, if I think the market's going to go up, is because if the market goes up, I get to keep the premium as long as the market closes in 1 hour. Right. And actually we got the after hours too. So it's got to close after the hours. But as long as this option expires today, above the red line, I get my $142. That's all I have to do. It doesn't have to go up. And if we put a call option in there, and maybe we should do that as an example, we should also buy a call. So we can buy a call. We'll buy a call at the exact same price. All right. So we're going to come in and I'm going to mark it into the call. And it's not going to let me. Okay. 0, and we're going to go to calls. I'm going to see if it'll let me have one right at the money. Oh, we're going to ask in 470. So we're going to have to go up here to 470. Place the order. All right. So now we can come over here to our positions and we can watch both of these orders and see which ones makes money. All right. So we put them in. Granted, we didn't put them in at exactly the same time, but we put them in pretty close. So if the market rises, both options should make money, right? That's the idea. You sold one, as long as the market's above the premium, I'm going to get my full, as long as it closes above the red line, which right now looks like green because the call option is on top. But I'm going to get my full premium. I'm going to get my $142. All it has to do is close above the line, and I'm guaranteed my $142. Now, on the call side, I paid $235. See that? I paid $235. Now, if this thing expires and it doesn't move up above $235, I'm going to lose $235. So $235 is, let's give us a little more room here to see. Move some of these down. Where's $235? So $235 is right here. So the market has to go to 235. That's about 237. So there's our break even. All right. So that at expiration, not right now, but at expiration, that will pay for the premium that we paid, 235. So any profit would have to come in from above this. So anything above this would be profit on the call. So anything up there. So if it went up there, I'd make $500 on the call. But if it doesn't, if it just stays, right in that region, if it closes below that yellow line, but above anywhere below the yellow line, I'm going to lose all $235. All right, on the long call. Now, it's up $27 right now. So yes, you could pull it off right now, but we're talking at expiration. At expiration, if that thing's not above that break-even line right there, we're going to lose $235. So you'd have to take it off early to take your profit. So we're up $30 right now. So as long as the market continues to rise, both these orders will make money. This is what I call one in the hand, two in the bush, right? When we trade options, people get so sick of me saying that, but it's one in the hand or two in the bush. Two in the bush is the long call, because you got a lot more money potential with the long call. If that market takes off and goes up and breaks all-time new highs before the market closes, I mean, if it really starts to rip and comes up here, you would make $887. Now, you'd make more than that. You'd make $887 plus $237, but you have to pay $237 for the premium. That's your break even, right? $235. So it's got to be above there. Anything above there, once it gets to $237, will make money. Now, this one here, we're up $42, and we actually have to give money back, because when you sell an option, they immediately give you all the money. So in this case, they gave us $142. Now, if we were to get out of the market right now, we'd have to give them back $97, which means we'd get to keep $47. That's what that little table right there on the side means. All right. So you received 142. If you sell it right now, liquidate it right now, you'd have to give them back 97, and you'd get to keep 45. But when you buy a call option, you give them 235, which is, the opposite side of the guy that's selling it. You're going to give them 235, and then you get to keep 15 or 12 right here, $12 in profit, and they're going to give you 245 back. Okay, so you're just offsetting it and going the other direction. That's how you think about puts and calls. In my opinion, puts are easier to understand. You sold something, they give you $142, and then if you sell it back, they're going to give you back, the difference. But some people understand calls better. You bought something, but then if you sell it back for more than you bought it, you got to keep the difference. But they're going to give you back what you sold it for. So you bought it for this and you sold it for this, so you got to keep this. Does that make sense? That's what those little calculators over on the left-hand side are doing for you. All right, let's get rid of all of our drawing tools. So right now we're just making money. Both of them are making money. The question is, which one will make more money? Which one will make more money? Depends on if the market goes crazy. I got to put my dollar calculators back in there. $235 to, I can get it right about 237. Right there. So that's our break-even line for the long call. Anything above that is profit. So if it breaks up there on our long call, we'll make all kinds of money. $800 clear up to there. The max amount of money we can make on the put is the $142. That's the one in the hand. We got that one. As long as the market stays above our green line. Now, the difference here too is the other side of this. What's your max loss on the put? You have unlimited loss potential. If this thing turns and falls and goes all the way down here on the put, well, you have unlimited loss potential. You could, if it comes clear down here and you don't get out, you could lose $3,950. All right. You get the guaranteed 142. That's yours, as long as the market stays above your green line. But if it drops below your green line, you have unlimited loss potential. But on the call option, if you put a call option in there, it's just the opposite. The maximum amount of money you can lose is $235, but you have unlimited profit potential. All right, because there's two sides to every trade. And if you're going to buy something that has unlimited profit potential, whoever sells it to you has to give you that unlimited profit potential. He's the one who has to pay for that unlimited profit potential that you have. Well, why would he ever do that? Well, because he's going to get $142, or in this case, $235, because that's your call option. So you're going to give him $235 and he's going to give you unlimited profit potential. The only reason he'd do that is because he doesn't think the market's going to go up. Thinks the market's going to go down. And then he'll keep his $235 in premium. All right. So you play both sides of the game. You can play one side or the other. It just depends on which one you want to do and how confident you are. You say, Lan, I don't want to ever have unlimited loss potential. You have unlimited loss potential when you do this. Come in here and hit trade and go buy market. You now have unlimited loss potential. So it's like, what are you scared to have unlimited loss potential? You take unlimited loss potential all the time. The difference between getting in with a contract and having unlimited loss potential is that you also have unlimited profit potential. Whereas when you sell a put option, you have unlimited loss potential, but your maximum profit is capped at the amount of money you sold it for. So if you sold it for $142, that's the maximum amount of money you can have. But the market doesn't have to go anywhere to get it to you. All it has to do is just stay above your entry point. So there is that. Right. So we have two unlimited loss potentials on right now because we just put on a long call we just bought one. Right. So we have a long position here. And the long position is now up. Which one of these is the long position? Days till expiration is this one, 37. It's up $50. All right. So this is just an experiment. So this is the way you guys should be trading this stuff to find out which one you like best. I like put options. I really like to day trade with put options because it makes it easy. Especially if you got kind of a market that you think is going to rise, but you don't think it's going to explode. And the S&P does that a lot, where it's just kind of slow and methodically kind of dead, marching higher, but it's not really exploding. Because the call option really has to have it explode to make a lot of money, because it's got to get past your cost of the premium. It's got to pay for the premium first, and oftentimes that's about all it ever does. Gets up there and maybe pays for the premium, and you just end up not making anything. So this put option, okay, our call option, this market's running pretty good. We're up $87 on our long position. Now we didn't get that in at the exact same time, but we're up $75, but it's got unlimited loss potential. We haven't put a stop in there to stop our loss, which, it's a good idea. We've got $82 on our put. So the sold put is up $82 and our long call is up $117. Now, $117 isn't enough to pay for the premium, $235, but we don't need $235 because we still have time value, right? We have intrinsic value, which is what we're looking at now. And we have extrinsic value. So the extrinsic value is the time value, and we still got until expiration of the option. So there's still value in there. So as this market is kind of exploding, it's kind of doing a nice little run higher. We're up $120. Now, if you think it's going to peak out here, you could take your 120 off right now. You wouldn't have to worry about the 235 that you paid for it. It's going to give you the 120. And then you've also got the put option that's giving you the 85. And you've also got the long call that's giving you 62. So we're up $250 right now. I kind of want to take it off. Take the profits and run right now. But this is an experiment, because this is where oftentimes you'll take your Fibonacci ruler, right? And you draw this in here. And we're right back here at the 50% level right now. It's playing the 50. It broke through it. Tried to go to 61.8, but it's backing off right here at 50. This oftentimes is where we get this reversal point right here. Here, here. And then we get the next drop and the next leg down to the 50% level of the Nash. Big move like that. And we're going into the close. And oftentimes people don't like to buy too much into the close. Oftentimes what this buying right here is just the people who took short positions buying to get out of their short positions. So they're making money. They're taking profits as the market goes back up. They're getting out. All right. So that's what makes it stop and pause here at about halfway up. Nobody's buying anymore, because they're really the only buyers that are in here are the buyers to offset their sold positions. That's why it stalls out right up in here and turns around and flushes once again. So see, you can see your contract's already down 62 bucks. See, the market's just turning and flopping down back down on us. Let's hang in there for a minute. Could you put a put option in there, Lan, and buy a put option, protect yourself? You could do all kinds of stuff. You could wind this thing up into all kinds of things you could do. But the more complex you make it, the more difficult it is to manage it and unwind it. So just keep that in mind. So we got 2 rally bars, 1 pullback bar, 2 rally bars. We're all the way back down to 32. I see we're up 250 bucks. That's all I had to do is pull back. But look which one's ahead now. Still our put option. The one we sold is up $52. That's our biggest winner right now. Why? Because it's still above our red line, our entry point. And that's all it has to do. It just has to stay above that line. It doesn't have to excel. It doesn't have to profit. It doesn't have to make money. It just has to not lose money. And this is right there. That's the example. It's a tiny example, but it's the example why I like put options, why I like to day trade with put options. Look, my put option is still at 50 bucks. My position is down 87, and my call option back to 0. So this is kind of a micro level example, but that's the example I wanted to give you today, and that's perfect. That's just what I wanted you to learn today. Well, Kirk, you've come to the right place. If you have a struggle reading the markets, that's what we do here. That's our focus. Help us learn to read the markets and figure out ways to try and make money off of reading the markets. All right, look, our put option is still our sold put is still at $52, $55. It's just hanging out right there. Kind of getting a little bit of a rally there on our call. So it's back up to 17. Now remember, the call option has much greater potential for profit. But the market has to really go. It has to go to get that money out of a call option. Whereas the put option, you'll get your money out if it just dies. All it's got to do is just stay above that green line. And it's actually the red line, but the red line is underneath the green lines because we put them right on top of each other. All right, here it's coming back a little bit. Trying to rally a little bit. Come on, buddy. Come on. Come on. Now, another thing that's cool about this is you can come in here and you can say, all right, I'm going to liquidate my call option. And I'm going to set this up. Oh, they changed the way they do this. And you're going to receive $275. 262 spread. So you can set this up so you can want to receive. Now we paid $235. See, they don't do the little calculation for you anymore because they switched to a different clearing firm, and the clearing firm doesn't do the math for you like they used to do. That makes it hard. So 235 is what we paid. So 235. See, and it doesn't even show you the percentage anymore. Oh, that's sad. They're trying to get it back in there. I know they are. So 235, that would get break even. That's what we paid for it to liquidate this thing at 235. We just get our money back out. But we would like to have a little profit. So we're going to go, I want to have, if you have 235, 10% would be 23 and 20%. I want 20%. So we're going to go clear. 235 times 20, let's say 25% equals $58. So I'm going to go 235 plus $58 equals 293. So I'm going to run this up to 293. 287, 293, 287. We'll just go to 287. I'm going to place that order, and I think I'm doing it right. So now when you make 200 and roughly almost $300, 297, it'll take it off the table for you. So the difference between 235 and 297 will be your profit. All right, that's how that's working right now. They'll make it better. They'll get the percentages back in there. They switched to a new clearing firm, and now they're dealing with trying to get some of the features back in. So that would give you, what did we say? That was a roughly 25% increase on your money. But look down here now. Oh, you guys can't see it. Oh my goodness. Get out of the way, land. Get out of the way. Here, you guys can't even see all the whole thing I was trying to teach you. Wasn't even coming through on this. Oh my hell. You dumbass. The whole thing I wanted to teach you was these numbers right here, and I was covering them up. All right. So what we're seeing now here is you're seeing that the long position that we put on is down $75. You're seeing that the long call is down $15, but the put option that we sold is up $45. All right. So that's what we're trying to watch here. And I did put a limit order on there to take the profits if it hits $287 on the long call. And that order's in here. That's a pending order. It's going to be over here in this window right here. You can see it's pending right here. So we're going to sell our call with a limit order at 575. Okay. And we know we did our calculations on there. 575 is going to be about a 25% profit. Come back over here. All right. So the market kind of stalled out. Our put option is still making money. See, that's why I tell you, I like to day trade with put options. Now it's coming back down. If we get down to the point where it's like, oh, geez, we're going to lose money, you could just kill it, take your $40 and get out. But as long as it stays above the line, you can still make money. Just needs time to decay. Now we could go down to a smaller time frame too, and we can see more action. Let's take this down to let's take it down to range bar 6. Come on, load me up, load me up. Hikanashi. Okay, look at that. Ooh, you can see right where we put all this stuff on a smaller time frame. So this is our line right here for the put option. That's also where we got into the call option. You can see it already turned. It's starting to come down. This is where we got in with our long call. Look at that. Our long call that we got into is now down $150. So you have unlimited loss potential with the long call. Land, I'd have got out by now. I know you would have. Of course you would have. You wouldn't hold on to it in anticipation of it turning around and coming back again. You'd have got out by now. You crossed the yellow dots right there. That's where I'd have got out. Me too. That's where I'd have got out. Yep, for sure. Yeah. Mm-hmm. So now it's coming back down. I just want to keep watching these options. It's a good lesson for us to talk about. If you guys have any questions, ask. If it's making perfect sense, then I'm assuming that if you're not saying anything, I'm assuming it's making perfect sense and you guys are learning and you're saying, oh, wow, that's really cool. I'm going to day trade with some put options here. It's what I like to do because I like time decay. See, this is the full contract size right there. That's why you have unlimited loss potential. Negative, see, extrinsic value. This is your maximum amount of money you can lose, $32,000. That'd be if the S&P went to 0. Chances of that are pretty slim. And if it did go to zero, it wouldn't matter anyway. what would have to happen to make the S&P go to zero? Nuclear bomb, maybe. And if that happened, it just wouldn't matter. Your little account's not going to matter. They ain't coming after you for the money. All right. What's it going to do? Is it going to turn around and start going back up again? Are we going to get a little? We got a little bow tie in there. Can you see the bow tie? Everybody sees the bow tie, right? Y'all see the bow tie. Bow ties here, 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 back down, tie off the bow tie. Just like that. There's another little bow tie. You guys all see them, right? I mean, they pop off the screen like popcorn. See little bow ties everywhere. So here's a little bow tie. So that means it's come down. It's touched this little region down in here. It ought to start turning around and start going back up now. All right, go to the moon and we'll give us nice little 3-drive pattern. Drive 1, drive 2. Let's see if it'll give us that third drive up out of there. It might not. Nothing says it has to. It's just what we expect and anticipate, right? We need to see it rally a little bit. We need to see it not make a new low. Stay up there, buddy. But the only thing making money for us right now is our sold put. Come on. Come on, little S&P. Don't you want to go up? Don't you want to go up? There it goes. There it goes. Let's look at it's getting that tired afternoon time. Look at this. We're down 35 on our long call, down 125 on our long contract, and we're up $42 on our sold put. Even though the market's still coming down, we're still green on it. All right, that's not good. We want to see it turn around and go the other way. Come on, buddy. We could sell another put. Oh, look at that. Now even our put's underwater. Now, the thing about this is if that market closes underneath our line of the put, we lose the whole amount, $142. All right. We lose it all. If it's 1 penny below that right now it's a yellow line. So if it closes, market close, which is, the market doesn't close, it's the after hours count on these options too. So you get an hour after, a couple hours after the market closes, then it's still got a couple of hours. All right. So it's starting to go back. We could sell another one. We come in here and we could sell a put here. Why didn't that let me sell a put? Cancel. Come down here. Options. We want to go into here. Why am I not getting puts? Why am I not getting my chain? There's something not right with this thing. My whole chain's gone now. Wonder why the options chain disappeared. Now my closed positions have disappeared. Oh, I didn't have any closed positions. Positions are there. All right, positions, closed, options chain. Where's the options chain? Okay, well, there you go. There is something wrong with the software right now. Can't put another one in if there ain't nothing there, if it ain't reporting. I wonder if we pulled up the real version, if it would be different. All right, it's bouncing. There, it's bouncing. Come on, buddy. That's what we want to see. Come on, come on. See, trading like that, it's anxiety, but there's nothing to do, and that's okay for a lot of guys. They don't want to be active, right? Passive, passive. This is called day trading here. This is not scalping because you're just kind of waiting for something to happen, just getting in and managing your positions, but you're not really jumping in and out all the time. That would be scalping. This is day trading. Okay, so we've got an order to take a position off at 25% on our long call, but it's down $50 now. The only thing that's up is that long or that short put. But it's not up very good. It's up $35, which is still green at least. Ooh, look at that ugly little bar. That's an indecision bar. That could be good for us. That could be turnaround. They're not pushing it back down. Now they're trying to go back up. There's another indecision bar. Fuzzy tops and fuzzy bottoms make for fuzzy trades. Is that what Claire said? I think fuzzy tops and fuzzy bottoms. Cat whiskers. That's what she calls them. Claire calls these cat whiskers right here. Look at all the cat whiskers. She's like, what does that even mean? All right, that's indecision. That's what that means. And right here, that's good. We want indecision right here because it's coming down. We don't want them to. Let's see a little indecision in here. And maybe that indecision will turn the market and start driving it back up. You know, there's a whole bunch of orders sitting right here waiting to be filled on a long position. And there's also a whole bunch of orders right down here pushing the market back and forth. The traders bracket those markets. So there'll be traded lots of trades above and lots of trades below. Uh-oh, that's not good. There we go. Come down, hit all those limit orders to buy and go long, and up it goes. Come on, baby. We want it to go up. We want to see that third drive. We'd have to meet our little arrows, our third drive arrows over here. Come on, third drive. When is it no longer the third drive, Land? Well, if it breaks this low right here, which is kind of low, it's down here. So if it breaks that, but that's, you're almost right in here somewhere. If it breaks down in here, that's the real low right there. So it is what it is. It's way down there. But if it breaks that, it's no longer in an uptrend. You're no longer making higher highs and higher lows. You're making lower highs and lower lows. Come on, don't do this to us. How confident are we think the market's going to go up? Not very confident, but if you were confident that thought the market was going to go up, you could put a limit order right there. If it comes down and touches it, that would dollar cost average your other position down by 50%. But then, of course, if it kept going down, you'd lose twice as much money. But if it started to go up, you'd start making twice as much money. See, it came down and touched it once, twice, 3 times. Once here, once here, once here. Now you got your order right there. If it comes down and touches that and fills that order, that'll bring this down by 50%, and it won't have to go back that far to get back to break even. But that's because you're making twice as much money, right? Oh, there's our bell, 45, 145. So we have 15 minutes till the market closes. It's very indecisive right now. Let's see this candle close green, and we'll be happy. That'll make us happy to see that little candle close green. Come on, candle. Okay, our long position, we never got our limit order field. It's still sitting down there. And we've got the S&P, the long call. It's down 40 bucks. Our position that we got into is down 100. Would have been nice to have that limit order field right there. Boy, it's dead, right? Remember, we got the 10-minute bell here. Now look at that put option's already back up 65 bucks. Time's decaying on it. Now, the brokerage firms want you to close out your positions, about 10 minutes. That's why you get all this activity around the 10-minute bell. The brokerage firms want you to close out all of your expiring options right now. They don't want you to let that thing drag out and go into the after hours and expect the exchange to fill those for you. And it's not a good idea, because I know a guy that did that once. Told a story. I don't know him personally, but he was telling a story where he let it go into expiration and it went into after hours, and then the market flushed afterwards and he lost like 30 grand. So just say, well, it's expiring, it's worthless, it's no good, I don't have to worry about it. No, just do your due diligence. Pick up the broom and dustpan and go in there and clean up after your mess. Just close everything out before the market closes. Okay, we got the 10-minute bell coming up. 13, 47, 48, 950. Oh, we got 3 minutes before the 10-minute bell. The 10-minute bell, the market usually jumps all over the place, remember? That's because everybody's offsetting their positions, getting in and out, closing out everything. And I think that happens exactly at 10 minutes because there's a lot of quant systems, right? Computerized systems that do it. So it's timed. It's right at the time, right at the exact timing. Come on, I'd like to see a little rally right here going into the close. Our put option is up 80 bucks. Our long call is losing 42. Our long position, of course, our long position didn't get in at the exact same time. If we put all these orders in at the exact same time, our long position would probably be making the most money, right? It would be up $187. So that's really not a fair comparison, because we didn't put this on until way up here, right? We didn't put it on at the same time we put these options on. So our long position would actually be, but of course the question was, would you still have it? Because you'd probably got stopped out either up here, maybe here. Where would you got stopped out? Or would you still be in it? Probably not. Almost guaranteed not. So we can get rid of this. Pull out the dustpan and clean up that mess. All right, here goes our ABC pattern. Back up again. Now remember, these are some buyers in here who are buying the short positions. They went short here. That's why these are red, because they sold. And to offset those sales, they have to buy. So to buy, that's going to force the market up. So some of these orders that are in here buying are the people getting out of their short positions. That might have been right here. And then we had this little dip, and now these might be actual buyers coming in again. Look, our sold call, or our sold put is up 70%. Our long call is up 4%. Which would you prefer? Well, now if the market went to the moon, of course you'd want the call. But if it doesn't go to the moon, how often does the market go to the moon? That's the question you have to ask yourself. Are you happy with the one in the hand? Or are you going to sacrifice the one in the bush? Right? The two in the bush? Sacrifice the one in the hand because you want the two in the bush. Well, how often does the two in the bush ever come? Uh-oh, our call option got paid off. Look, it took the money out. We hit our limit order, took our $52 out. Look at that. So we said on our call option we would take it if we made 25%. So that just closed out, and we made, does it show a percentage in here? Percent gain lot 52 rate. It doesn't show our percent. I wonder if I could turn it on. Filter show current chart only show. Oh, this doesn't have that. Show for all current chart bases. No, I want this. I don't have that in the futures version. I don't have that fancy list. Oh, look at this thing took off. We'd have been better off not taking our profits off our long call, huh? We took it off at 52. Now we're making money. We're up 122 on our put, up $100 on our long call. There we go. Those little magic butterflies are pretty cool, aren't they? Fibonacci butterfly. Higher highs and higher lows. It's up there testing that previous high right now. And if this was real money, I'd be looking to exit the whole position right now, take it all off, because we're getting into that point where the brokerage firm really wants you out of there. They don't want you to take it past the close. Now, this is the futures market, so they don't care. They'll let you take it past the close. They just want you out before the real close. Let's bring our stop up here for our long position, because we're losing money now. It's coming back against us. We'll just push it right up there. If it breaks that, then we'll get out. Let it see if it wants to go a little higher, but that's where we'll get out and take our profits. If it'll break up there, we'll push it up even a little higher. There it goes. There it goes. Push it up a little higher just to lock in some profit on that. Come on, buddy. Keep it up there. Lock in a little more. Don't want to get too close. Let it go. But we're going to lock it in, so if it does just suddenly turn and flush, get out. Look, we're up $135. The max we can make is $142. We've made max profit on our long call, or on our short put. We've made the max amount of money we can make right there. $135. That's 94% profit. Take that baby off. There's no reason to risk everything for nothing. Oh, there we got stopped out. Let's liquidate this. Oh, our stupid system is. These options they're something broke. Options chain is still completely gone. Positions, we can't get out of that. Liquidate the option there. Maybe that'll help. Market out of that thing. There we go. We got it. All right, completely done. We got to make a phone call into the programmers and ask them what's going on with options. But there you go. That's a nice little example. That's a little disappointing that we lost our options. All right, we closed out that nice little last few minutes, $385. That's not bad. That's a good way of trading. I think you guys ought to practice that selling puts and calls and buying some calls and then trade against each other in your demo account a few times and see how you like that. That sell and put options to trade, day trade. I like it. It works well for me. I like to go in and just say, you know what? I think the market's going to rise, but it might not rise very fast. So I'm going to put a put option in there and just collect the premium rather than buy a call option hoping that it makes a big explosion. Now, this did. We'd have probably made more money with our long call if we'd have hung on to it and not put the order in there to take the profits at 25%. But that's a neat little strategy for you too. I want you to know. All right, there we go, guys. That's how it works. And we will come over here and play with some other stuff. Let's play with some AI stuff. We would never use AI to get a celebrity endorsement. This little celebrity right here.
Look, folks, I was reading this thing, Pitt News, right? Great stuff. I mean, back in Scranton, we had newspapers, but I didn't have, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
Subscribe to Pitt News Magazine. Come on, guys. If you don't have your Pitt News Magazine, What's wrong with you?
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
Of course, we better let Claire give us a little talking to.
Hey, it's Claire. If you love trading tips with a side of sarcasm, hit that follow button and subscribe to Pitt News on air at pittnews.com. I'll be here every week, unless I blow up my account again. You know how some people read Pitt News Magazine for the charts and strategies? Me? I started reading it for the pictures, and now I write for them. Go figure. If you want trading content that's smart, useful, and doesn't put you to sleep, oh, and occasionally features me making up terms like tail fuzzies, head over to pittnews.com and subscribe. And hey, if you find my picture in there, don't judge. They caught me mid-espresso.
All right, guys, that's probably, I probably ought to show you the software I'm using, even though
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's it. And even though they're having a little problem with the options right now, I'm sure we'll get that turned around very quickly. And I will let them know that there's something not right there. And we'll have that fixed hopefully for class next time. All right, guys, we will see you next time. Thanks for stopping by. And class is tomorrow morning, bright and early, 8 a.m. We're going to be going through our UBI, Universal Basic Income portfolio. I've got my new spreadsheet, 98% done. And I want to show it to you. It's coming along nicely. I think you'll like it. And it's kind of just looking at things from a totally new concept, but working pretty well. So come and join us 8 o'clock in the morning for our stocks version. All right, we'll see you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.